Imagine a ball bouncing in a room. It hits the floor and bounces up, hits the ceiling, and gets knocked down. Prices follow this rhythm. The floor is support, where buyers create demand. The ceiling is resistance, where sellers push the price lower. This diagram shows how that physical space looks on a stock chart. We identify the swing lows and connect the bottom peaks to find our support. Then we look at the swing highs and draw a line across the top peaks to map our resistance. The goal is to find price levels that have rejected the market multiple times. When an asset hits a specific price and reverses direction over and over, we know we found a key psychological boundary. These thin, perfect horizontal lines provide a clean starting point. But in practice, the market rarely respects a single exact number, meaning a trader relying on total precision often ends up watching the price hit their stop before reversing in the intended direction. The market is messy. Often, the price drops slightly below your exact line, stops you out of your trade, and then immediately shoots back up in your favor. This is called approximation risk. To fix this, we need to expand these lines. Support and resistance are almost never exact price points. They are zones. By drawing a rectangular area to capture the slight variations in the swings, you build in a margin of error. The next problem happens when traders try to map every single reversal in the asset's history. You end up with a chart covered in hundreds of crisscrossing lines. You cannot make a clear decision when your screen looks like this. We solve this with the proximity rule. We sweep away all that ancient history and leave only the immediate support zone below the current price and the immediate resistance zone above it. Focusing strictly on the nearest active zones removes the visual noise. You are left with a clean, readable map of where the market will likely react next. Let's test this map. Watch as the current price climbs and enters the upper resistance zone. Pause for a second. The price is hitting resistance. Why is it a bad idea to immediately open a sell position right here? If you enter immediately, you are gambling that the level will hold. The market frequently pushes past resistance in a fake breakout, which will wipe out a premature position before the real trend begins. Instead of guessing, we wait for confirmation. This chart shows two signals aligning. First, an evening star reversal pattern forms directly inside our resistance zone. Second, the volume indicator spikes above its moving average, confirming major sellers are actively stepping in. Now, we execute. We place our entry after the reversal candle closes. We set our take profit at the lower support zone. Crucially, we place our stop loss entirely above the resistance zone, giving the trade the breathing room it needs to survive minor fluctuations. A price zone is an alert. It tells you where to look. It is the combination of candlestick patterns and trading volume that gives you permission to actually risk your capital. Sometimes, the market will completely break through your level. This brings us to polarity. Watch as the price surges through our resistance area. When it drops back down, that old ceiling acts as our new floor. We approach this retest with the same discipline. We wait for the price to hit the new support zone. A large bullish engulfing candle appears, and the volume spikes, showing us that buyers are heavily defending this new level. With our confirmations locked in, we take the buy position. We tuck our stop loss safely underneath the new support zone, and the price cleanly shoots toward the target. To execute this consistently, you follow a strict sequence. 1. Draw your levels as zones, not thin lines. 2. Delete old, irrelevant historical data. 3. Wait patiently for the price to reach your zone. 4. Confirm the reversal with candlestick patterns and volume. 5. Set a stop loss that allows for minor market noise. By anchoring your decisions to these specific areas and demanding confirmation before acting, you eliminate the guesswork. You replace random speculation with a methodical, high-probability system.